And I do have the pleasure of introducing our next guest presenter. Peter Ricchiuti will be joining us. There we go. Trying to stay on time. I'm a minute behind. I'm going to introduce to you our next presenter, Peter Ricchiuti. Peter's originally from Boston, but went to New Orleans just as soon as he heard about it. Not sure, Peter, but we're going to hopefully get some more insight on that. He's been featured widely in the financial media, including the Wall Street Journal, the New York Times, Washington Post, CNN, CNBC, and Barron's. Peter has addressed more than 1,100 groups in 47 states and several countries. He is also the host of Out to Lunch, a weekly business show on National Public Radio in New Orleans. Peter teaches finance at Tulane University, where he's received numerous teaching awards. He is a business professor that you wish you had back in college. Peter's presentation synopsis here is Peter will be discussing how financial markets are often a great predictor for what's ahead for the economy and specific industries. Please join me in welcoming Peter Ricchiuti. Peter?
Appreciate it. Thank you so much. I enjoyed John's presentation. Got people to jump up and down. Everything it was like we were a cult or something. Last time I did that, I was signing up for the Branch Davidians. So things are picking up. I teach at Tulane. I've taught there for 35 years. I have been there a long time. I've been there so long that students come up to me and go, my mother had you. And I'm like, what are we talking about here, And it has been wild. But I don't mind, I'm getting older. I don't mind, I'm quite a bit older than my students. I'm at that stage of life, probably like yourself, where the term pulling an all-nighter pretty much means sleeping through the evening without having to get up to pee. So I just met a lot of you in the men's room, actually, which is kind of appropriate. I'm not afraid of actually going to one of those retirement centers, though. You ever been there? The male-female ratio is awesome. It's going to be like high school with money. If you can drive at night, you're George Clooney. So let's take a look at what we've got here. We're going to talk about the financial markets and the economy. And I know a lot of you are saying, there's an economist speaking. That's great because I had run out of Ambien. But this is not going to be like that. So let's see there we go. Don't take any of this too seriously. What's going to change after all this? We've basically gone through COVID. What are the changes going to be? I think some of them are, in fact, permanent. In fact, a lot of them are permanent. We're going to see simpler supply chains. We're no longer not going to be able to make a car because a tiny plastic part comes from South Korea and it can't get over here. What's going to count is not just cost, but reliability and cost. More efficiency, smaller head counts. A lot of the people who were employed are not going to come back. There's been a lot of efficiencies and a lot of ways to save money. Succession planning, I think that's something a lot of people hadn't thought about. But people realize now how vulnerable they are. If somebody goes, what happens next? So when you look at public companies, Wall Street is really demanding that you have depth on the bench. And I think that's going to be a big difference. And then greater online buying is, of course, one of the big things that's going to happen. One of the things you should be thinking of is, what did COVID do? It didn't change the course. It just sped the course up. A couple of things I'll get off the bat right off the middle is the stock market is not the economy. That's where most people go wrong. The stock market is a measure of future corporate profits. So it doesn't care if people are happy or enjoying their job or anything like that. It's really all about corporate profits, and that's what you have to keep your eye on the ball on. So when you look at how well the market's done since March of 2020, it's really a function of the fact that these companies have been able to restructure themselves to really make themselves profit machines going forward. So this is kind of what we're seeing. That's why investors are so optimistic. Although I've been doing this for, about 42 years, and I cannot believe how crazy these markets are. Basically, I was always taught, and I believe that stocks are a function of their earnings. Now we've got memes, whatever the hell those are, and we've got SPACs and Bitcoin, and this is not going to end well. I just want to tell you. That's when 17-year-olds are telling you where to put your money, it's a bad sign. So let's say the majority of the people, one of the things you need to think about is most people are wrong when it comes to the economy and the markets. In the early 1900s, 2/3 of Americans felt the country was on the wrong track. And the 90s turned out to be a great time to invest. They were way off on that. In 2000, 80% of Americans thought the country was on the right track, and the markets did nothing for an entire decade. And then in 2010, remember, we were coming out of the 08-09 recession, nearly everyone thought the country was on the wrong track, and the markets have soared ever since then. So it's very difficult. You always have to be swimming upstream. I know when I go to a cocktail party or a crawfish boil, and people ask me what stocks I'm buying very fundamental kind of companies that nobody cares about, and it'll be like, let me freshen my drink, I'll be right back, and they never return. And so you can't really be following the crowd in here. Let's see. Oh, I want to give you a little confidence in me. This is a stock picking contest where I went against arguably one of the top financial minds in this country, Mike Ditka, and I was able to beat the coach. So hang in there with me. Let's see. Natural gas prices. Louisiana is one of the largest producers of oil and natural gas, so I think we had a pretty good idea on this. And basically, we expect natural gas prices to remain really in a very, very tight range, around that $3 a thousand cubic foot range. And that's kind of what we should be projecting going out to the end of 2022. Housing starts are like a lot of economic numbers right now, where you're seeing them soaring. But after that, you're probably going to see them start to level off. And that's what we think. We're going to come back to something that looks more like it was when we started all this out. Let's see. Oil thoughts. I mentioned we're big producers of oil and gas there. If you want to go back to what has happened, remember in 2016, the Saudis were really upset about how much of the market share of the U.S. Energy industry was taken on, especially that shale oil in West Texas. I don't know if you've ever been to West Texas, but it's a lot like Mars. It's really, you ought to take that trip out there. And they were producing so much oil that we were, of course, a net exporter and such. So they basically opened the spigots. And they got prices down. Their supply and demand determined the prices. OPEC had been determining the price for 42 years. And, of course, it fell from about $128 to about $28. It lost about $100 a barrel. And so that was the beginning of it. And a lot of people say, the reason we're not drilling is, President Biden has cut off the Gulf of Mexico, whatever. The reason we're not drilling is the prices aren't so strong. And the other thing is, even when they are strong, there's no faith whatsoever that prices are going to hold up going forward. It just isn't. If you look at those deep water projects in the Gulf of Mexico, they're about $1 billion. And if you take from the time they bid on the property to the time they get that energy back to the beach, it's about 4 years. Think about making $1 billion investment on something that 4 years from now, you have no clue what that pricing is going to be. And that's why people have got their hands tied. They've got plenty of inventory out there. That's not what's stopping them, as they just don't feel like they have the pricing. In the short term, the oil we found domestically is going to hold down prices. And in the long term, it is going to be alternative fuels, which is going to be the big player in here. I mean, there still are a lot of deniers out there, and it's not, that's a dozen people in California is what it is. No, it isn't. It's coming, and it's going to be huge for us. If you want to know how big it's going to be and what the difference is going to be for oil, take this for example. You've got 70% of all energy is used for transportation. And so if you look at the electric vehicles that are coming, and they're here now, they're kind of novel, but they will make up more and more and more of the fleet. And when they get to a certain point, things are going to change. Like right now, it's still hard to find a charger. Or you talk to people all the time, like, where are you going to go, Whole Food? That's not the way it's going to work. You know how capitalism works. You're going to go to bed on a Tuesday night, there'll be no chargers, and you're going to wake up Wednesday morning, and there's going to be one on every corner. And so that is going to be a big deal. You take companies like, and you could do this domestically, but the first shot across the bow was the big three automakers in Germany, Volkswagen, BMW, and Mercedes, that came out about a year ago and said that by 2030, they no longer intended to make an internal combustion engine. Just think of how much oil is not going to be needed in here. And it's going to be a very, very, very big change going forward. Let's see. The economic impact of these lower oil prices, I know they've been creeping up, and the pump is up a little bit right now, but it's been saving consumers billions of dollars. This is good news for retailers, U.S. manufacturers, and other businesses such as the airlines. The other thing it's done is that the nations that really hate us, like Venezuela and Iran and Russia, they're entirely oil-based. So when oil prices decline, they have nothing. They couldn't throw a blender at us. So that's kind of the extra part that comes from all of this. All right. By the way, I know you people are good at math, so I got a few math things in here. And sometimes you speak at a group and you just mention denominator or something, and then everybody freezes. You're not those people. Because you remember what they say? They say we're only using 20% of our brain. And every time I hear that, I think, damn, what am I doing with the other 70%? So you're a much better group for me here today. And I mentioned going to those retirement homes. You ever been in there? You're not going to feel very comfortable because it's a lot like college. People living in close quarters, a lot of drugs, really the same thing. So let's, yeah. The rise of electric cars, it's just going to be staggering the way it comes in. You look at, we've been talking about Tesla, and Tesla's got their base model down to about $30,000, $35,000. It's not an expensive thing to do. But I think the big tipping point is, for instance, the Ford 150 truck that's gone into the electric powered. That's gonna really begin to gain a lot of momentum in here. Distinctions. This isn't for you, of course. This is for everybody else that doesn't get it. But electricity is, of course, generated by natural gas, coal, solar, and wind. But trains, planes, and automobiles run on oil, or the derivative oil of gasoline. So we can kind of see where the difference is between those. Most people think it's all one. You of course don't. You've probably seen something like this, and this is basically the idea that we're going to need so much more electricity. You folks are in the catbird seat, but plus it's a lot of pressure too. But you are in the catbird seat, and where's it going to come from? Well, there's no question we need the electricity. It's what are the fuels behind it? And basically what you're seeing is coal will be less and less, nuclear will come down, renewables will go up, and natural gas will go up. So going forward, if we were to come back in 5 years together in here, it would be the percentage of renewables and natural gas would be higher than it is right now, particularly considering the renewables. Now, a lot of people still have belief in coal. I don't think that's really true. I think coal is over. If you want to know how coal is over, just look at the Kentucky Coal Museum in Louisville. It is now powered by solar. I think that is it. Sometimes somebody just gives you a measuring point, a goalpost. That is it. So that was the biggest excitement in energy is all happening, about 200 miles southwest of New Orleans, kind of on the Texas-Louisiana border. And that's LNG, liquefied natural gas. And this is a part of the industry that a lot of money has gone into in the last 5 or 10 years, about $50 billion. It's the most expensive investment in private funds ever put into one industry. And what LNG is, of course, is you've got all this natural gas. We buy it for like $3 or so. And of course, some places like West Texas where they're drilling for oil, natural gas is just a byproduct. So it comes down in here, comes in the pipelines, and goes around Lake Charles, Louisiana, Port Arthur, Texas, right about in there. And then they take that natural gas and they freeze it. And way beyond freezing, they lower it to 265 degrees below zero. And it cuts the size of the natural gas into 1/600th of its size, so they can compress it and put it on these ships. And of course, they can buy the natural gas at $3. You get about $6 a thousand cubic feet in Europe, and about $11 a thousand cubic feet in Asia. So really, what it is arbitrage. It's kind of amazing technology and arbitrage. So even the fact that you cooled it in Louisiana and you freeze and you heated it back up where in its final destination, it's still, the difference is very, 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 very profitable. One of the things that surprises people is they don't understand how the stock market has done so well, for instance, last year when the unemployment was so high. And the truth of the matter, and this is why it's so hard to make money in the markets, is that unemployment rates and stock market returns they're inverse related. And it doesn't. It's another example why the stock market isn't the economy. It's a function of corporate profits. Look at these numbers. In times when unemployment rates have been less than 4.5%, that's sort of just where we were before COVID, the average rate of return for the market is 8.35%. The average overall, by the way, is a 10% annual return in the markets. 4.5 to 5.5%, a little more, 8.69%. When you get unemployment between 5.5 and 6.8%, annual returns have been 14.61%, and higher than 6.8%, returns have annually been 18.73%. So this just shows you how difficult it is to make money in the market. Those bottom two are times when everyone is telling you to get out. And the top ones are when everybody's telling you to get in. So it's an inverse relationship between the economy and the unemployment and the markets. A couple of things you hear a lot. Mostly what you hear is not true. I think that would be there is a real shortage of, the truth is in short supply. Manufacturing myth, you hear this all the time. We don't produce much in this country. Well, we've never produced so much as we do in this country right now. But we don't need as many people to do it. That's what it is. So it's not that we're not manufacturing anything. It's because we've become so efficient. Productivity has gone up so much, and we need it to go up to compete around the world. So it's a real positive. I remember, my sons, this must have been about 10 years ago, my sons were 11 and 8 years old, and we went to the Coca-Cola bottling plant in New Orleans. It was brand new, and it was the top of the line. They've never built anything this efficient. And so we went through the entire tour with the manager, and at the end, it was about the size of 3 football stadiums, and there were about 6 employees. And we said and the manager came over, and my sons asked about all the robots. He said, you know what I like about robots? They don't have fights with their wives. They don't come in hungover. Of course, my kids are like, stranger danger, so it is, but that's really the truth. And so 87% of all job losses are to manufacturing efficiency and productivity and robotics. So that's really what's important. Everybody's got these scapegoats that it's, job loss or immigrants or companies going abroad. 87% of the job losses are just really thanks to efficiency. Business cycles, you can kind of have a pretty good idea of where we are right now. And if you look at it carefully, you can see that we are basically back to the early cycle. And the economy always has an early cycle, mid-cycle, late cycle, and a recession. Capitalism and democracy are the only systems that work. But you have to know that capitalism is cyclical. That's just the way it works. Things come back, they get too overheated, and then they go back down into the cycle and start all over again. Now, it does seem that every time we go down, we reach a higher plateau on the next round. But let's take a look at early cycles, and this is where we are now. Fiscal and monetary stimulus. You've got the government spending a lot of money, and you've got the Fed keeping rates at around, basically zero. And by the way, politicians need to keep their hands off the Fed. They know nothing, and the Fed is the smartest people on the planet. I have former students at the Fed. I have friends at the Fed. They are smarter than me. They are better dressed. They have less body fat. These are really good people. They know what they're doing, and they are trying to create a soft landing for this U.S. economy. And if they hit it, we all ought to just get on our knees and thank them for this. This next stage is going to be very, 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 very difficult. And, I don't like the idea of politicians being in charge of the economy of the Fed. It's like, it is recently come to my attention that some of our imports now come from other countries. So we don't need that kind of insight. So let's take a look at that early cycle, where we are now. Fiscal and monetary stimulus, spending money, rates at zero, economic growth starts to increase, and this is what we're seeing. The mid-cycle, probably not too far from the mid-cycle now, margins start to peak, because you remember in the early cycle, these companies were doing it with very few people. The margins were terrific. So margins start to peak. Management begins to increase share repurchases on the public side. And that's a way to get earnings up. In the late cycle, you've got fiscal and monetary restrictions, which is about where we were before COVID. Employers have trouble finding available workers, and wages start to increase. There is no question that the Fed is going to have to start tightening up on money. They are going to have to, because otherwise we'll overheat and we'll have too much inflation. And I've just been doing this too long. I started in this business in '79, and I'll tell you, when inflation heats up, the value of financial assets goes down. It is the killer of prosperity and is the killer of financial assets. So the Fed is going to do all it can to kind of keep those rates down. Their goal is 2% inflation growth a year. That's what they're trying to hit. It's a little higher than that right now, but I'll talk to you why. But I think that these inflation levels won't keep up. I think they're transitory, that dealing with supply chain issues and such. I don't think we're about to hit runaway inflation. Late cycle, you've got fiscal and monetary restrictions. Employers have trouble finding available workers and wages increase. And then the recession is economic contraction following falling manufacturing and retail activity, and earnings and credit quality start to drop. So it just repeats itself over and over and over again. By the way, as mentioned earlier, I have a radio show on National Public Radio in New Orleans, and it's what I do every week is I bring in two entrepreneurs to Commander's Palace, and if you've ever been there, it's one of the finest restaurants in the world, and I bring them on for lunch, and we talk about the joys and troubles of running a business, and it's a lot of fun. We have a great time with it, and I've had the wildest guests. I had a guest a couple of years ago that I keep thinking of. He invented a case for your iPhone that turns your iPhone into a stun gun. It's really kind of amazing. It shoots 7 million volts. And the reason I think about it all the time is that when you stun somebody, it recharges the phone, which is so great. There's leading to such uncomfortable situations as, sorry, Stan, I was low on juice, let me pick you up. So then I had a woman on just before COVID, and she and her partner had this is typical of how businesses get started. She and her partner were at that age, 27, 28 years old, when you're going to weddings like every weekend, and of course you're broke because you have to, it really hurts your pocketbook to keep coming to these. But they were sitting in the pew, and one said to the other, well, I hope Ellen is happy, and the other one said, Ellen was last week, this is Emma. It's like, oh, okay, I hope she's happy. But they noticed that weddings spend a ton of money on flowers, maybe $10,000 on flowers. And of course, today's generation doesn't want to throw things away. They want to recycle them and such. And it's a lot of money. And so they started renting flowers for weddings. And what they are is very, 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 very high-end artificial flowers. They come in a box that smells like flowers. It was right on the table between us, so I know I couldn't tell the difference. And they're doing... imagine the margins are pretty amazing because you send the flowers out and they send them back to you and you use them all over again. And they were doing 450 weddings a month. I mean, the great thing about the show I do is that all of these companies, they're not Silicon Valley companies. They're all doing things that, when you're in the car, you think, well, I could have done that. And it's like, yeah, but you didn't, they didn't. And that's the whole problem in here. So it's very exciting to see those new ideas come along. People ask why I'm the most optimistic guy in the room. I think part of it is the show, and part of it is working with young people. Do not sell this generation short. They are smarter than we were. They are more community-minded. They are going to make a big, big difference. And so I think, being with them. And the other thing you'll be surprised on a college campus, you might not notice it unless I said it, but no matter what college campus you go on, it's now decidedly female. It really is. I mean, Tulane is like 60-40. I have friends that teach at schools that are like 70-30. And everybody is trying to make it 50-50. So women should be very proud. Guys, I don't know what the hell happened to us, really. But it is really, really very interesting. Let's see. Mythbuster. In fact, this is kind of what we were talking about early. Avoid investing when the stocks in the economy are slumping and unemployment is high. We know that's just not the way it works. It's the opposite of that. Here's some important math, and this is what happened to us in March of 2020, where you've been hearing a lot of numbers that just don't seem to mesh with you, and it's because of the market math. There's just regular math in here. The market drops 20%, and it takes a 25% increase to get it back where it was before. If you look at what happened in March of 2020, the market fell 34%, and it took a 52% increase to get us to where we were before the March 20 collapse. And to give you some easy math, the market falls 50%, it takes a 100% increase to get you back to where you were. Just think about it. The stock's at 20, it drops to 10. And that's a 50% drop. But in order to get the stock from 10 back to 20, you need a 100% gain. And this is why these big losses are so tough on a portfolio. You just need a much, much bigger upside to make it work. And I'm using more math with you. It's mainly because I just realized how smart you were. This was going to work out great. You know the old story, Yogi Berra goes to a pizzeria in Brooklyn. He orders a pizza and he goes, sits in the booth. And the waitress comes back with the pizza and she's got that slicing thing. And she says, Yogi, you want that cut in 6 or 8 slices? And he goes, oh, 6. There's no way I'm hungry enough to eat 8. And so that's the kind of thing you guys don't fall a trap for. That's good. Profits count a lot over the long run. Stock prices move in line with corporate profits. In fact, if you look at it, these are corporate profits for the S&P 500. If you look at it, the recession started to really pull out around 2011. You had record earnings for the S&P 500. They was $61, then $85 the next year, $98, $104, $110, $118. If you look at it, 2020 was the decline. You saw earnings go from $165 to $132, and you saw the same decline percentage-wise back by the stock market. And then, if you want to know why the stock market's doing so well right now, is first of all, in 2021, the year we're in, they expect earnings to go to 170, higher than they've ever been, and we have a market that's higher than it's ever been. And in 2022, the estimates are that it gets closer to about $191. So this is why the market's up. I go places all the time and they say, oh, the stock market, it's a casino. It's like, it's not, and it's casino. I don't know why they do that, but it isn't. It's really based on corporate earnings. Oops. Can I go back one, if you can do that for me? Do I have that ability? Oh, yeah. Hold on. Look at that. It's so great. I've done a lot of technology over the last 15 months. I spend most of my days trying to convince some mysterious person that I'm not a robot, and I'm always accepting cookies. Who wouldn't, really, when you think about it? Let's see. Annualized rates of return under different presidents. People always, have these arguments, and once again, a lot of spin. But this is how it shook out. The best one in the last 60 years or so, Bill Clinton, the market was up 15.2%. Under Barack Obama was 13.8%. Under Donald Trump, 13.7%. The only loss you see in here was the 8 years of George W. Bush. And the market had a very difficult time during that period. And of course, that includes the 08-09 recession. And a lot of people had trouble with George Bush, but I remember after 2011, something happened that I knew he was right, and the rest of the country was wondering if maybe something had happened to him. It was right after 9/11. He came out and he told people, as Americans, the best thing they can do for America is to go shopping. And everybody's like, oh yeah, good idea, And I'm like, yeah, I'm under my desk, but I'll meet you at the food court. And of course, the truth was, he was right. That's what you needed to get the economy going, is to go out and buy. And there's nothing Americans are better at than shopping. So that really worked out. The shift, and we know the shift's going on, it's just hitting faster and faster. All the things we're talking about in terms of those changes, not only were they happening anyway, and they speeding up, but I remember I visited a company in Dallas with our students, and I asked the CFO when some technological change would really come into the forefront. And he said to me the most interesting thing, it was kind of profound. He says, I'd give you a date, but it's before that. And that's sort of the way it's going. All the things that we're predicting are going to occur much quicker than they are on paper right now. So the shift is, of course, that more and more of us are working with our minds, and fewer of us are working with our hands. That will just continue to go that way. Although there are tremendous jobs in the trades that somehow young people don't seem to know about, but this is the direction we're going in. What's also been happening in the markets, and why the markets have done so well, is we know that stocks and the stock market are actually pushed by earnings. Earnings per share is what does it. So if you look at what's been going on really in the last 15 years, one of the reasons the stock market has done so well is that companies have spent trillions and trillions of dollars buying back their own stock. And this is the way it works. You know that earnings per share is profits divided by shares outstanding equals earnings per share. Well, if you're taking your extra cash and you're buying back shares outstanding, now you have the same amount of profits maybe divided by a smaller denominator is going to get you a higher earnings per share, which is going to get you a higher stock price. And you can't really blame anybody for doing it. I sat on the board of a public company. We did it. It's kind of a layup. You could take a risk by doing something, some new expansion or such, but it may work out, it may not work out. But in terms of earnings per share, that's kind of a layup. So that's one of the things we've been seeing. This is what I mentioned earlier, is that in the average in the average family, the wife is more educated than the husband. And the most interesting thing about that is how big a gap has been closed there. You can see that. You see it just crossed relatively recently, but what a gap was made up in terms of where those used to stand. Here's something you can take with you, even if you leave here and you go, oh my God, I don't remember what I learned, but I do remember this slide. When you get a rental car, one of the big problems is, of course, you get the rental car and you drive around for business and you returning it back to the airport. And just before you get to the airport, you realize that the tank is only half full. And you start to freak out and you think, oh my God, I've got to fill up gas before I bring it in because Hertz charges like $15 a gallon, right? There's which is why they call it Hertz. And but it is. And so you pull off at the last second and you find that last gas station and then you panic one more because it's not your car and you can't figure out what side of the car the gas goes in. But in any car, if you look at the fuel gauge, there's a little gas pump and an arrow, and that's where you put the gas. So, really, I know you're going to thank me later. I swear that's going to be the. You'll say, "Oh, what did the Italian man say again?" People hear you're Italian, and they always say, "So say something in Italian." I always say, "The body's in the trunk." It's my father would kill me if he heard me doing these things. Our economy is 70% consumer driven. And that's the way it is, that's the way it's always been, and that's the way it's always going to be. So, and the truth of the matter is a lot of people don't get this right. They think that the driver of new jobs and everything else is the upper super zillionaires, and it's not. The driver of new jobs is the middle class consumer. And the one thing we have to do is make sure we have an economically viable middle class. That is the key to the whole economy. I'm going to say, this is going to sound very curt, but the rich already own everything and the poor can't afford anything. It is the middle class that determines the strength or the weakness of the U.S. economy. And so this is what we're going to have to keep our eye on the ball on. Which is why, for instance, in 2017, there was a big tax break for the very, very, very wealthy and corporations, and the economy didn't do anything afterwards. And it's because, if you give $100 to a very wealthy person, they already own everything. Most of it just goes back into savings. But if you give it to a middle-class person, they'll spend every penny of it. And that's one of the things we're supposed to be surprised about in 2017. By the way, people keep asking, where is the middle class? I mean, where does it? I think everybody disagrees with this. But just to give you some guidance, I think this was done by Bloomberg, is that if you look at it, the middle class, they think, is when you have income between basically $47,000 and $141,000 is middle class. That's the way most people describe the middle class. Now, it's really up to the viewer, obviously, but that'll give you some sort of perspective on it. And also, if you look at the middle class by wealth, you get a very interesting number. This kind of tells you how things are. If you have any assets, in other words, if you have assets minus your liabilities that's just positive, just $1, you're middle class. And then if you, in terms of wealth, if you get up to about $400,000, that would be considered middle class. So it gives you an idea when you hear the terms, this is basically what they're working off. Everybody's going to disagree with, think it should be higher or lower, but I think that'll give you a little bit of perspective. Over the next 30 years, the population of working-age people will slowly and steadily increase in the U.S. Now, all of this is immigration, every piece of it. We are at a 35-year low of making babies. I don't know. I'm not going to get into your personal lives, but I really thought COVID would have created more of a bump because there was nothing to do, So, but it didn't. That was my whole premise, and it didn't work out. So without immigration, it shrinks. Now, if you look at, we're in better shape than many of the other countries. If you look at the other industrial parts of the world, including Europe, China, and Japan, their populations are actually sinking. We're actually getting lower. And so we're better, but in order to get this economy rolling again, you're going to see that the economy grows, the GDP grows at about 2.5% a year. And it's been doing that for the last 25 years. And no matter who's president, no matter what's going on in the economy, and it's because we don't have enough people. We don't have enough working age people. If you asked an economist what the single most important metric was to growth in a region or national economy or the world economy, it is a population of working age people. So, we're going to have to do something with an immigration policy because we need the folks. Immigration stat, over 40% of the Fortune 500 were started by immigrants or their children. That's kind of startling. That really is. One of the reasons maybe they can't get many openings with corporations to just start their own shops. At Intel's Science Talent Search this year, less than 20% of the applicants, the ones that could really make it through the process, had parents born in the U.S. And then during COVID, all of us realized that about 25% of the nation's physicians are foreign born. I don't know what we would have done without them. Which inning are we in? I'm originally from Boston. Been in New Orleans 40 years, married a local girl, raising 2 Cajun kids, got the whole thing going. And if you look at, that's why I put Fenway Park on there, the scoreboard. The last expansion lasted 128 months, and that was the longest expansion in history, the history of the country. And the bull market lasted for almost 12 years. Both of those are the longest in history. Since World War II, the average economic expansion has been about 90 months. So you get a pretty good idea of how long that one lasted and how we just forgot that they do come to an end. So that was kind of what occurred to us on that. Going forward, I think you get some interesting numbers in here because, and by the way, we talked about the changes in energy consumption. I mean, there are companies that aren't going to make it in this new paradigm, that there are going to be oil companies that don't make it. Of course, some oil companies have done better at diversifying than others. That's just the way it is, but it's not going to be a particularly great business to be in. Being able to hang in there is going to be like, being the tallest jockey. It's not going to be. It's all going to be kind of relative and such. So if you look at these estimates, and this comes from the Congressional Budget Office, look at where they're predicting. Is in 2001. Where we are right now, they think GDP will be 6.5% growth. And that is because things are ripping and roaring right now. They really are. Now, it's a mess because our supply chains can't keep up. We can't find labor. It's all over the board, but it should be about 6.5%. Very, very high. But it can't maintain at that. We don't have the people. So in 2022, they expect GDP to drop to 3.3%, and then in 2023, be right back where we started, at 2.2%. And that's what's in the cards here. Inflation, we're about 2.4% when this year is over. It's running over 3% right now, but 2.1% in 22 and 2% in 23. So you can see what's happening. The Fed is not moving because they think that the inflation we're seeing now is transitory. It's not going to continue. And so that's why they're not raising rates right away. They're looking at things, but they're not raising rates because they think by doing nothing, it'll just go back to where it was before. And they're probably right. Unemployment is now, it's kind of a mess, but technically it's 4.5%. In 2022, they think it'll drop to 3.9%. And when things shake themselves in 2023, be 3.5%. So this is kind of gives you a good idea of where everything is. And if you look at that 2023 number, look at it straight up and down, those are the normal numbers. You get through this bump, and you get to 2023, GDP up 2.2%, inflation at 2%, and unemployment at 3.5%. Exactly where we started all of this. Let's see. Oh, this is a little something I was working on. I can tell you, but you have to promise not to tell anybody outside of the room, is that I have discovered that interest rates are directly tied to the height of the Federal Reserve Chairman. And it took some work, and I don't share it with everybody, but I like you guys. So if you remember, I started in this business in 1979, and Paul Velker was a very big guy. He was like 6 foot 6 inches, and inflation rates and interest rates were really, really high. He had 18% treasuries. And then it came down, and then Alan Greenspan was a much smaller man than Paul Velker, and so that came down more, and then Ben Bernanke was shorter than Alan Greenspan, and Janet Yellen was kind of tiny, and Jerome Powell is about 6 feet tall, and I think rates will start to come up again eventually. So there's just don't tell anyone where you got that. Let's see. People are always curious about what to do with their retirement accounts. You know, they've made it so complicated. I think the financial industry has made it complicated on purpose, so you need all that help. I just wanted to tell you what I do with my retirement account money, and it's so simple, and I think in the long run, it gives you a lot less angst, and it's a really good formula. If you have a 401k plan, for instance, the percent you ought to have in stocks is about 100 minus your age. So if you were 40 years old, you should have about 60% of that portfolio in stocks. The reason is that over long periods of time, stocks will outperform every other asset class. But they will be more volatile. And the thing you fear is that when it comes time to need the money, you're afraid the market is at a very low point. So let's say you're 40 years old, you might have 60% of your money in stocks. If you're 50 years old, maybe it's 50%. So you can see it's starting to decline as you go down there. The part you invest in stocks, don't go crazy. Don't rack your brain on this. Just use no-load index funds. They outperform about 70% of all mutual funds. Just do that. You don't have it. You need to just concentrate on something else. So these no-load index funds, they cost nothing to invest in. And the situation here is that you ought to diversify within these no-load index funds. So what I would do, this is just me, I would put maybe 1/3 of that stock money in the S&P 500 index, which is the large companies. Then I'd put another third in the Russell 2000 index, which is small cap companies. And I would put the last third, in international stocks. That's kind of where U.S. individual investors are falling down. The average U.S. investor has about 5% of their money internationally. And more than 50% of all stocks now are abroad. Not only that, those countries are growing faster than us, and those companies are growing faster than U.S. companies. So it's really a pretty good thing to do. And then I would put the rest of it in some sort of no-load bond fund. And here's the key, is to reinvest the interest and the dividends. Have them just keep compounding on each other to buy more of that fund. And what happens is, over time, every month you get your paycheck, every month it does it. And psychologically, the reason it works and the reason you can be so calm is that, let's say the market goes way down. Well, if the market goes way down, you're not happy about it because your portfolio is worth less, but there's an offset. The market's gone down, and this new money coming into the market is going to buy stocks, going to buy funds at a cheaper level. So that's an offset. Now, if it goes the other way, where the market goes way up, you're very excited that your portfolio is worth more, but the new money is going to buy funds at higher and higher prices. But that's the two offsets. You don't have to worry about anything. You can just keep calm. And then I would say to rebalance the account every 2 or 3 years. Take a look at it. Because if now you have a lot more in large cap stocks than you did in small cap stocks, realign it back to where it was before. And then what it does is it basically allows you to sell high and buy low over and over and over again. But people have made this so complex, and do not put Bitcoin in your IRA. I mean, I don't know what we're going to think 5 years from now. These pure craziness is going on here, and we're watching it. It's really amazing. But there's still some very good companies out there paying dividends relatively cheap, and nobody wants to look at those anymore. I teach old-fashioned value investing in school, and those students look at me like, I like him, but he's a dinosaur. He just doesn't get it. And I think, no, you're going to die. That's what's going to happen. So it's not. I'm very confident in this over time. Let's see. Some random thoughts. Tax evasion has added about $3 trillion to the national debt over the last decade. I don't know if you're like me, but I watch TV late at night, and those ads come on. It's like, that's right, I owed Uncle Sam $500,000, but thanks to Ned, I paid $4. It was like, you're the problem. You do that in Texas, and everybody hides because open carry. I don't know, you might have a gun with them. So, let's see. You could be for Obamacare, against Obamacare. It just doesn't matter. The bottom line is that 1 in 8 workers in the U.S. is of normal weight without a chronic health problem. That's the issue. We're not taking very good care of ourselves. It's not a function of who's paying what or where it comes out of. We just don't do much. And then the tax bracket reality, I'm just going to show you this. People have always said, I'm paying more in taxes than I ever did before. And if you're very, very wealthy, that's not true. In fact, if you look, I know the numbers are very small, but that peak marginal tax bracket, you can see was actually over 80% in the 1950s. 80%. It's now 39.6% is the new proposal. And the 50s are a time we just look back in reverence. It was like Ozzie and Harriet and Father Knows Best, and the economy was doing well and everybody had a car and a house. That's what the tax bracket looked like. And you can see basically on the lower end of the tax bracket, it's had little ups and downs, but it's remained pretty much flat. So you can kind of see what's happened. The other part that kind of skews people is the idea of income. Like one of the things you'll hear people say is the middle class hasn't got a raise since 1970. They haven't really made any more money. And then employers are going, well, wait a minute, it's costing me more and more to have an employee. And how can this be? Well, nobody's lying. They're just looking at it a little differently. The employee is looking at the fact that I might be paying them pretty much the same, but the cost of those benefits has gone through the roof. So in terms of the total package, I am paying more than I ever did for an employee. And of course, the employee is saying, I guess that's true, but I don't have money to spend. And so they're both right. Like so many of these are, even the argument politically in the United States right now. I think, first of all, we're going to be okay. We're very divided right now, and it really is kind of crazy. You know, if you're too much left wing or too much right wing, you'll just fly in concentric circles. That's really the problem with that. And I think the reason we're going to be okay is we're sane people. We all want a better life for our children. We all want to be able to do the things we want, to have a vacation, to feel financial stability. And it's just, if you look at it, it's a bell curve. And there's crazy people on each end, and we got to cut them off. I don't know how you do that, but but that's the thing. We're all pretty much have the same set of values. It's just that we're being kind of egged on by all the people on the fringes. Nobody's more of a capitalist than me. I am really the consummate capitalist. I teach capitalism. I invest. I do all of that. But I got to tell you that capitalism is under fire right now. And the reason it's under fire is this right here. And we've got to do something to make capitalism survive. The first is, if you look back at the time of the French Revolution, that was 1789. You remember that? That was when that nice girl got her head cut off. Was it Antoinette? And so things went badly. And so at that point, 3% of the French elites, which is what we call them, which is probably everybody in this room, commanded about 30% of the country's wealth. Now in the United States, the top 3% control 40% of the country's wealth. It's this one-sidedness in the wealth and income distribution that's really got people riled up. And so we're going to have to do something to preserve capitalism, because I mentioned before, it's the only system that works. Another thing that's happened, and this, by the way, is nobody's trying to do this, is we keep having these K-shaped recoveries after a big calamity. What I'm about to show you happened after 9/11, it happened after the 08-09 recession depression, and it happened after COVID. Is you see the economy falls off a cliff, and we know that. It falls off a cliff and everybody goes down to a point. And then about halfway down, the upper class start to do a lot better than everybody else. Now the reason is the Fed lowers interest rates to basically zero where we are now. And when it happens, when they lower the rates, the value of assets, real estate, stocks, bonds, soars. So if you have those assets, you're somewhat offset. The economy might be slowing down and weaker, but the value of what you own has gone up dramatically. And that's, of course, what we've seen here recently. And the lower and middle class don't own those assets. Maybe they have a bank CD or a money market fund, which are now getting paid nothing on, and they just continue to fall. So, and this is not done on purpose. In fact, Jerome Powell, the head of the Fed, has said repeatedly that the biggest threat to the U.S. economy is this economic opportunity split. And so it's funny because he's the guy lowering interest rates to zero because that's the tool he's got. He has to do it, and it's worked. Frankly, it's really worked. But it exacerbates what he thinks is the greatest fear out there. So it's kind of an interesting thing that's occurred in here. New and improved. Yeah, I go around and people seem so nostalgic for the past, and it's so much better than it is now. It really is. I hear people say, it was better than we made our own soap. Yeah, terrific. That's great. It is so much better for the majority of us. The babies, Warren Buffett said, the babies born today are the luckiest crop in history. And I just love the vision of a crop of babies. I just love that image. There's they're knee high. Look at them, those babies. So, And so he's right. He's right. The average American today enjoys access to better transportation, entertainment, and communications and medical services than the robber barons did in the 1930s. But we somehow miss that. We somehow miss that. This nostalgia piece that just doesn't make any sense. We're doing a lot better than we ever have. When somebody confronts me on this, that it was better back then, I always come up with one word. I always approach them with the word dentistry. There's a take it off. So that usually ends that conversation. The other thing that's happened is the split, and you can kind of see that. Remember, we just talked about hands versus minds. This is the other reason the country's kind of split in half, is based on education. If you've got a bachelor's degree or higher, since 2000, you have done really pretty well. You've done much better than the average bear. But if you have some college, you're probably about breaking even of where you were before, and less than high school degree or less than high school, you've gotten further and further and further behind. And that's the haves and the have-nots in the economy, and why we've got so much split and so much anger. So this all has to be worked out. The national debt has been growing for decades, but really won't become an issue until interest rates start to rise. What counts about the debt is the interest on the debt. I know we've got a big number out there, but in terms of day-to-day spending, it's the interest on the debt. And with rates where they are now, it is not a threat. It's not a threat at all. But at some point, interest rates are going to go back up, maybe higher than 3%, for instance, on the 10-year Treasury. We're about 1.75 right now. And so that's where the Fed is right now. They have got to stick a soft landing. They have got to get this economy, they've got to raise interest rates and slow down the economy to get right back to where we were before, a healthy growth level, without raising interest rates so much that you get real trouble with the amount of interest we're paying on the national debt. This is going to be NASA if they can pull this off. This is going to be, and everybody should be rooting for the Fed. There's no question about that. Let's see, a young man turns 13 but one time in his life. And this morning, this is for a bar mitzvah I'm doing on Saturday. Sorry, wrong notes. Easy mistake to make. Let's see. This comes from the Brookings Institute, and it's about at what age are you happiest? And I think this is so funny when you start to think about this, is that at 18, you're pretty happy. You got a driver's license and a boyfriend, and things are pretty cool. But then you go into the workforce, and you're the low man on the totem pole, and you're getting paid less. You're working more. You get the worst assignments. And then after that, you're still down in this area because now you've got teenagers at home. That's terrific. Can't get any better than that. And so then after that, you're kind of taking care of aging parents, which is an important stage of your life and something that's you really, at the end, have tremendous pride with what you've done. But it's another difficult time. And then when you're about my age, I just turned 64, apparently it gets so much better. So my message today is don't die. It's really, just walk out here thinking, don't die, because it is going to get a lot better for you. So, and the other thing, of course, is that a happy do-nothing retirement is a myth. One of the other people, I said that I get a lot of young people on the show with new companies, new businesses. The other side of it is people that are having a second act, that they worked with a career their whole lives, they went home, they played golf on the first day, they went to the museum on Tuesday, and then they didn't know what to do on Wednesday. So, and that's really the thing, is people have a second act to try something different. And a lot of them are starting little businesses, and it's pretty terrific. So that's the side note to that. These are the books we use on campus, either in their entirety or a couple of chapters. The first book is One Up on Wall Street. I think if you had a young person and you wanted to teach them the way the markets work, that's the book I would use. Peter Lynch was the money manager at Fidelity's Magellan Fund back in the 80s and 90s, and he really shot the lights out. And he wrote this book about how he did it and how he found those great stocks. And it's a great thing to give to a young person. It's written in standard English. You can read it under a tree in a day. It's a great thing to look at. And one of the things he talks about is how he found some of the great stocks that made him such a huge money manager. And sometimes he says, sometimes you talk to competitors. He went to visit Holiday Inn once in Memphis and their headquarters, and he asked them, who's your toughest competitor in lodging? And they said, damn, there's these guys in Texas called La Quinta, and they are kicking our butt. And so he thanked them and everything and went back to Boston to the fund, and he didn't buy stock in Holiday Inn, he bought stock in La Quinta, and it went up 20-fold. So a lot of times you can find that kind of information. Because right now I know what you're thinking is, where do they find this guy? And for heaven's sake, why do they let him work with children? And so I'm going to tell you in a few minutes, I'm going to show you about the program I work on and what we've all learned. Zebra and Lion Country by Ralph Wanger looks at investing in these small cap companies, these smaller investments, which is where we think the opportunity is. The Money Masters by John Train looks at 8 great investors and how they did it. And the little book that beats the market by Joel Greenblatt, he came to speak at our conference once. He's looking at companies today that sort of look like Microsoft and Walmart did 50 years ago, trying to find those same characteristics. 2 books by Ben Graham. Ben Graham was Warren Buffett's professor at Columbia in the 1950s. These are very analytical books. I tell my students, put them on your desk, even if you don't read them. Very intimidating to other people. And then where I get my sources, I read Barron's, The Economist, the Christian Science Monitor, and Howard Marks, who I think is one of the smartest investors in the world. He writes a newsletter once a month, and if you just go to oaktreecapital.com, it's all free. And I think you'll get a big kick out of that. I think he's a very, very, very smart man. Let's see. Don't short the U.S. There's very, very easy to see the political divide, to see everything that's happened to us, and people want to get negative on America. Do not get negative on America. Anybody that's bet against the United States since 1776 is lost, and they will always lose. So if we could keep a more positive attitude, it's going to help build it faster. This is what people come up to me all the time and say. I guess they know what I do, and I always seem a little too optimistic, I guess. And people come up to me and they'll always say, the economy, it's a house of cards. And I will always tell them this paragraph, which is, as long as people have babies, capital depreciates, technology evolves, and tastes and preferences change, there's a powerful underlying impetus for growth that is almost certain to reveal itself in any reasonably well-managed economy. Capitalism and democracy are the only plans, the only systems that work. And where I just want to end with you here is, I think they handed out a little piece to you here. This is something my students do every year. What I do is I have this program I started called Birkenroad Reports. And what Birkenroad does, the only program like this in the country, we're in our 27th year. We've had 1,100 students go off to Wall Street from here. It's been quite a springboard. But every year I take 200 students, I divide them up into teams of 5, and each team is assigned to write an investment research report on a small publicly traded company that nobody knows in the South. In Texas, Louisiana, Mississippi, Alabama, Georgia, and Florida is where they're all headquartered. And we call these stocks under rocks. Nobody's ever heard of them. And we actually spend a day, we fly out and we spend a day with management. We've had the best site visits in the free world. We've taken helicopters to offshore oil rigs. We've gone to steel mills. We've been to chicken processing plants. If you've never been to a chicken processing plant, do take the family. That is a lovely outing. And it is, and I take a lot of abuse for that one, but I always point out that after a couple of years of therapy, these kids are fine, and that's what's important. I don't have a mean bone in my body, but the one thing I like to do is I like to take a student that maybe grew up very privileged, like maybe he was Manhattan private boarding schools, like come on, Julie, you'll be following Sanderson Farms, the chicken processing company. How was I selected? Your accounting background, get in the car, Julie. So it's, I love that. Excellent, Smithers, So yeah. But so that's what we do, and these reports go out to thousands of investors. If you go to birkenroad.org, I guess that's where that next one is. If you go to birkenroad.org, you can see all the reports, all 40 reports every year. We have a big conference every year. This year, our conference speaker was Liz Ann Saunders, a Charles Schwab chief investment strategist. We've had Mario Gabelli. We've had a lot of great folks. And what we do is we basically find these companies that no one else has really ever heard of. So if you turn to the back inside page, you can kind of see some of the names. And some of them you'll recognize and some you won't. But I just wanted to show you who they were, for instance, and how much we learned from these companies. Like, for instance, you see about about 2 inches down, you see a company called Crawford & Company. And talk to your financial advisor. I'm not recommending these or anything. But Crawford & Company is the largest claims adjuster in the world. And they go in, and every time there's a tornado or a hurricane or any calamity like that, they go in and try to figure out what the insurance companies owe these people. And it is pretty phenomenal. I think when you look at climate change, we're just getting more and more and more of these. Last year in the hurricane season, we had 30 storms. You know what 30 storms is? We ran out of names for them. That's pretty bad. And then we went to the Greek alphabet. We almost ran out of those. When it was the Greek alphabet, it seemed like the New Orleans was being chased around by a group of angry sororities. You know, it was like, ooh, come beta and zeta. You know, it was very difficult. And you see these innovations, like everybody wants to invest in tech. I'd rather invest in companies that are benefiting from tech. Like Crawford & Company now, if there's a tremendous disaster, like a hurricane or a tornado, they send drones in to take pictures to get that money as fast as they can. Pretty amazing stuff. If you look at Crown Crafts, right underneath that, they're the largest manufacturer of baby bibs in the country, and all that puffy stuff that you see inside a crib. They make all of that. So we've been very, very lucky to bring in these companies. You see a couple of companies you recognize. Roots Hospitality is Roots Chris and such. And so just wanted to hope you enjoy that. And then also the reports are all at berkenow.org. And then the radio show we do, talking to all these young entrepreneurs, is at itsneworleans.com. So we'd love to have you tune in anytime to either of those. And one last thing, I want to tell you the greatest experience I've had academically is in 2008, I brought 27 students to Omaha, Nebraska to spend the day with Warren Buffett. It was just incredible. I'll never ever forget this. And it was right in the heart of the economic depression. I thought he was going to cancel. He didn't. I do public speaking. You meet a lot of people. Some of them are nice. Some of them aren't so nice, the same way regular people are. And but he was very warm, very kind, very friendly. He took us all out for the restaurant, made us drink cherry Cokes because that's his favorite kind of thing to drink. And it was right in this terrible part of the economy. And I always remember one of the students asked, the first question he asked, he said, "Mr. Buffett, how bad is it on Wall Street right now?" And Buffett said, "It's terrible. I've never heard so many sad stories. I heard a story the other day about this investment banker, left his big office in Manhattan, went to his home to his big home in Long Island, meets his wife at the doorstop and says, 'Honey, listen, we got to talk because I'm not going to get a bonus this year, and I don't think I'm going to get a bonus next year. And frankly, we're going to have to make some changes around here. Like we're going to have to get rid of the chef. So, honey, you're going to have to learn to cook.' And she says, 'Well, okay, but you're going to have to learn to make love so we can get rid of the gardener.'" So it's I loved him from that. Thank you so much. I appreciate it. Thank you.